So in this lesson, we're going to build on the previous concept of trading different market phases, wave 1, wave 2, wave 3, wave 4, and wave 5. We're going to go a little bit deeper and talk about the fractal principle and specifically market cycles, larger market cycles. So the one thing to understand is that there are cycles in the market. We have runs, we have pullbacks, and so on. And these runs and pullbacks, they happen on the larger time frames, monthly, yearly. They happen on the lower time frames, weekly, daily, and they happen even on the micro time frames, which is 4 hour, 1 hour, 5 minute, as an example. So we have these cycles all the way from the higher time frames to the lower time frames. The important thing is to be in sync with the cycles. Let me talk about that by jumping on the charts here. So I'm going to show you an example of the S&P 500. We're diving into the stock market here, S&P 500, and I'm going to talk about the cycles within the equities market, which is also a reflection of the global economy and so on. So if we look at the chart here, we look at the monthly time frame, we can see that we had a recession, big market correction in 2000, 2001, big market correction in 2008, 2009, and now we've been in this big run. So we have a run, correction, big run, still no correction. On a larger economical business cycle, a typical correction happens every 7 to 10 years. Okay, so every 7 to 10 years we have a market correction. And here, as an example, the correction happened in 2000. So the last correction was at the beginning of the 90s, right? So we had roughly a 10-year run, then a correction, then a 7-year run, then a correction. Now we're in a 10-year run, and potentially there's going to be a correction soon. So by understanding that, you know that, okay, if looking at the chart again, we can focus our attention on making sure that we start investing at the beginning of that new cycle, the new run, okay? And then when we're getting at the end of the cycle, we should be making plans to protect our capital because there might be a correction coming. And this is where we, again, take maybe some quick short-term opportunities. And once the correction happens, we catch the long-term opportunities, passive investing, active investing, value investing, long-term trades, swing trades, all that good stuff. Now, the same concept is applied to the lower time frame, right? When there's a run on a higher time frame, such as the monthly, we can expect that the weekly chart is going to be trending, that the daily chart is going to be trending. So on a weekly and a daily, we also have cycles where we have runs and pullbacks. Same thing on a lower time frame, but on a lower time frame, it's not that relevant, where on a 4-hour chart and the 1-hour chart, we have runs and pullbacks and so on. The main focus will be that concept on a daily chart, right? So if we look at this S&P 500 here again, we can see that throughout this entire monthly run, and you can just follow the cursor, the daily chart has pullbacks and runs. That entire run on a monthly is daily pullbacks and runs, okay? There's a correction here, and again, we have pullbacks and runs. Now, potentially this ascending triangle breakout that's occurring right now, right? So again, the understanding here is that you need to get in sync with the market. Let me talk a little bit more about that. So to really conclude, right, that's kind of all that you need to know from the charts. We've looked at charts so much now that you guys understand that the Elliott wave theory, wave 1, wave 2, wave 3, wave 4, wave 5, the trending market happens anywhere from the monthly time frame all the way down to the 1-hour chart. It's fractaled down, the fractal principle. The understanding here is that we want to be in sync with the market. So what I mean by that is you want to be a little bit more patient on the corrections, patient on the pullbacks, and you want to get in sync with the runs. A lot of times I find that people get out of sync where they miss the runs and then they want to catch as much profit on the pullback because they missed the run. That is you being out of sync. So if you ever notice that you're out of sync, that you're hitting drawdown, you're getting loss after loss after loss, where are you in the market cycle? Okay, maybe you're just out of sync. You want to focus. If that's the case, you want to take a pause, a breather, a break, and wait for the market to get in sync again, to get aligned with the cycle of catching the run rather than the pullback. okay? Because when the run finishes, we're gonna have a period of consolidation, a period of a pullback, and the period of consolidation and pullbacks is typically when people have the most losses, period. So that's when you wanna really be patient, take only like those quick in and out positions, but mainly you wanna get in sync and catch those runs, period. That's market cycles in a quick little lesson here. There's not really much more to really say about it, but the fact is that market cycles happen all the way from the higher timeframes to the lower timeframes. It's the trend, period, right? So we want to get in sync with the trend, right? Whether it's investing long-term, okay, to day trading short-term and swing trading. We want to be in sync with the market. We want to be catching the runs and be a little bit more patient on the pullbacks, because that's where consolidation happens and so on. That is it. So that's it for this lesson. I hope you enjoyed it. It's a really, really important one, specifically the getting in sync part. It's a little bit of a mental work as well on your psychology and so on. So get in sync with the market. It's really important. That's it for this lesson. Hope you enjoyed it.